Okay, so now we're moving on to the macro outlook in part three. And when we look at the macro outlook at the moment, it does seem as though rates are close to being at their peaks. However, that doesn't mean that they're quite there yet. There could be a little bit more to go. Now, interestingly, Brazil, which was one of the first to hike, as they saw inflation spiking, they actually reduced rates last week. So, is that going to be the pattern for all the countries? I don't think so. And the reason for that is, as I've been writing, well, since last year, I think, that I expect most countries to leave rates at their peak until the central banks are confident that they've got this inflation beaten and they can see it at that 2% target level. Now, getting it to 2% is one thing, but it's a matter of whether they can maintain it at that 2%. And I think that they're going to want to see that there, as I've mentioned before, for 3 to 6 months of seeing that around that 2% level before they're going to feel confident that they've got that control back again. And, even when they do get that and they see that, and that still could take some time, because the closer it gets, probably the slower and harder it's going to get to achieve that. But you shouldn't expect to see rates collapsing. Indeed, for me, sort of any sort of lowering of rates, it's going to be such a gradual process because they're going to want to prevent sort of boosting demand too much and then seeing inflation start to rise again. And if you look at central banks' predictions, for a lot of them, they're not expecting to see this solid 2% inflation, at least until any time up until the end of 2025. Now, of course, this will vary between countries, and as we know, anything could happen between now and then. So, more fund managers and economists are expecting the US to manage a soft landing. Hopefully that's going to be the case. Unfortunately, I still don't see that that's going to be possible for Europe, and that includes the UK. Again, summer's okay. It's going to be potentially the weather that could have an impact there as we go into sort of autumn and winter. We were saved last winter because it was very mild. Is that going to be the case this year, or is it going to be colder weather, which could then put pressure on the economies, increase demand for energy, push inflation higher again? So I'm still not sure, but I don't expect it to be a long or deep recession. But in Europe, I would say households are generally struggling, especially sort of the lower and medium level household earnings. So China's likely to achieve around 5% growth, and for many, they think that that's sort of disappointing, but I wouldn't be disappointed with that. I think traders are expecting probably a little bit too much. Now, the fact for me is that 5% is sustainable. Where you look at the previous levels, they were impossible to maintain. So it does make sense where they are at the moment. It's doubtful that they will suffer from any deflation. Now that said, the growth sectors for China, they're mainly servicing and of course the high tech, while they've still got their problems in the sort of housing, construction sector, and obviously that's holding growth back in China. The government's trying to support the sector, and they're sort of adding enough credit or directly, indirectly, to get them to help them to complete developments, but they're not adding it just to allow sort of new builds to take place until that all the sort of existing stock is taken up. So that could take a little while. And the PBOC have pledged a stronger monetary support for the general economy anyway. However, the level that they can add is questionable as far as I'm concerned. It's obviously not going to reach the same levels as it did the post-subprime area. Now, they're in a reasonable position, but I think people just expect too much because of what they've managed in the past. In some ways, they have become more westernized in their economic management. But we could get too deep into that. So anyway, so now I'm going to move on. Just look at a little bit of the company news. So Amazon outperformed last quarter. Unfortunately, Apple can not say the same. Now, again, when we look at this, Apple sort of hovering around this 3 trillion market value, and that's under threat. And they could drop below that and remain below there, because when you look at them, they've put in 3 negative quarters now. They're lower sales. So, I would expect that this is due just to consumers having to prioritise their spending. So obviously when the growth comes back, then most people will be happy to spend all that extra money buying the latest iPhone or whatever they need. But at the moment, I just think people are struggling that little bit too much. What they've got works, so they don't need to replace it as if they want to. If they want that sort of latest model or not. And then when we move on, look a little bit at oil. So OPEC Plus, the Saudis extended their oil supply cuts another month, and suggesting they could go further if they need to. Now, oil has rallied last week. WTI hit $83 on Friday. So that is going to be encouraging for OPEC and OPEC Plus. However, can it, for me, if it gets through 84, 85, it's potentially got the chance to get up to 90, 92. Again, just remember, I'm not making that as a prediction. I'm just saying that there is the potential for that, when you look at the markets technically, that is. And of course, if it does start to sort of have that stronger, higher price range, then that could start to feed into inflation data within the next couple of months. And that is when the next round of central bank meetings will start after the summer recess. I think a point here is for Russia and the Saudis, they actually need these higher prices for just to finance what they're doing. So obviously for Russia, it's to help to finance their war against Ukraine, and for the Saudis, they're trying to sort of move away from all this reliance on oil income by investing into other areas. They've got this futuristic city that they plan to build, which is costing a phenomenal amount of money, called NEOM. And also, when you look, and you can't miss it in the papers, especially if you're a sports fan or certainly a football fan, that they are developing a sporting industry. When you look at what they're prepared to pay to attract the top footballers, it's crazy. Now, that said, they're only spending probably a few $1 billion on football, which is a very sort of relatively small investment for them. But it will, or it's sort of got the potential to have an impact on European football because of that. It could drain sort of a lot of that talent. you know, again, that money is just going to be so attractive to some of these guys, especially the younger ones as well as the older ones. And you can see that it's going to push transfer fees even higher, along with wages too. And I expect probably that a lot of the European clubs are going to try and sort of create tougher contracts for players. And obviously those buyout clauses are going to become huge numbers just to prevent losing all of their best players out to the Saudis. And then another inflationary prospect that's sort of dampened but not disappeared yet is with agricultural products. You know, the grains could still be impacted after Russia not only refused to extend the Black Sea deal, which allowed Ukraine to export, but actually began bombing the Ukrainian ports. And Ukraine has responded by sinking a couple of Russian ships in their ports. So, you know, that sort of that tit for tat could carry on. And the final aspect to consider with the grains is the weather. You know, we're seeing some extreme weather conditions at the moment. Most of that's thanks to El Nino. But, you know, and that is having an impact around the world. I mean, Beijing's had the heaviest rainfall in over a century. There was actually a 5.5 earthquake in, I think it was eastern China, the weekend. And again, you know, that could boost inflation. So that's pretty much the end of the macro outlook I've got for the moment. Most of it is sort of pretty consistent, only slight tweaks, but obviously the markets and, you know, the government, central banks and all that, inflation, everything is playing such a big part in, you know, how we look at what's going to happen as we go forward. It does seem as though inflation's peaked, it's coming down. It's just the pace that is going to come down. You know, these central banks have set this 2% inflation target as a sort of a generalized or average, or for different countries, different ways of looking at it. But again, you know, where did this 2% nominal value come from? And it came from New Zealand. And, you know, you should read up on that because that's quite an interesting story. So, okay, so that's it. I'm just briefly going to look at our services and then move on to part 4, which is our technical analysis. So I'm not going to read it all and bore you. Hopefully you've already seen part 1 and part 2, so I don't need to. But, you know, we provide great stuff. I mean, you know, you're getting all of our YouTubes, our daily newsletter. It's all free. We're just doing all this just to help you guys. And then, you know, if you want to improve, we've got our academy, and we've got such a variety of things there to help you, all the way from 1 day all the way up to our accredited masterclass. And of course, trader mentoring, and lots of other things. And again, if you're short of capital, then why not try one of the challenges through one of our partners? If you want to know any more details, our contact details are there.